conference. So, our next speaker, Mr.Krishnan Sitaraman, Senior Director, Financial Sector and Structured Finance Ratings, CRISIL, oversees credit rating assignments for banks, non-banking finance companies, housing finance companies, and insurance firms. He is also responsible for rating microfinance institutions and structured finance instruments across sectors. May I request him to inform us on the near-term outlook for the banking sector. Sir, over to you.
So good afternoon, everyone. Thank you very much. I know we are on the cusp of lunchtime. I'll try to make my presentation short. I've been asked to talk about the outlook for the banking sector. After the earlier session where Mr. Damodaran sir talked about his insights and thought-provoking nuggets of wisdom about this important matter of corporate governance, I am more on the nuances and mundane aspects of numbers, asset quality, capitalization, and so on. So let me talk about our key messages for the day. I think after a period of 4 to 5 years, when banking sector was on its way down, I think the nadir has been reached, and we are now looking forward from a growth path, so as to say, both from the point of view of credit growth as well as asset quality. We believe the worst is behind the banking system. Yes, there are many more things that needs to be done, as I will cover, but I think the worst is behind us. We are slowly coming out of the tunnel, so as to say, coming to the lightness. We can see light at the end of the tunnel. One of the key aspects is on the NPA side. We've seen NPAs increase from 3.4% to 11.5% over a 4-year time frame as of March 18. That's tripling in 4 years. And that was a very major area of concern for the banking system. In some ways, it is said that most of these NPAs were driven by corporate loans, big ticket loans. So there is a saying that in banking circles that if you lend to a small borrower and he defaults, the borrower is in trouble. But if we lend to a big borrower and he defaults, the banker is in trouble. So that is what has panned out on the NPA front. If I look at 11.5% March 18 banking sector NPAs, if I look at corporate loans, that is around 19%. So it's almost double the average lending rate, whereas retail NPAs or agri and MSME are lower than that. So conventionally, we say MSME is more risky, agri is more risky. But if you look at the numbers, it is the corporate loan NPAs which are higher. We believe that the fact that a large amount of these NPAs have been recognized, and the impact of the IBC, that is the Insolvency and Bankruptcy Code, will have a two-pronged effect. One, recoveries will come in, and two, additional slippages to NPAs will be lower. So that would mean that the stockpile of NPAs will steadily come down going forward. Profitability is also expected to turn around from this fiscal onwards. Till the fiscal before, FY18, public sector banks had a loss of together 90,000 crores. That came down to 70,000 crores in FY19. We believe in FY20, public sector banks as a whole will start making profits. Yes, some of them will still make losses, but the sector as a whole, because provisioning levels we expect to be not so high as in the previous year. One thing which remains to be a monitorable is the capital adequacy levels. Capital cushion over regulatory requirements is not high, while the 2.1 lakh crore capitalization from public sector, the government has helped public sector banks meet regulatory capital requirements largely, but growth capital is still not very sufficient. We'll still need more capital. The other thing is that of the 11 banks which were in PCA till recently, only 5 remain because of capital infusion and additional provisioning. Some of the banks have come out. So with that, key messages, looking at some more of the details, if you may. Credit growth as I said, had reached a low a couple of years back. Now it's on the way up. Last year was around 12%. And from a gross bank credit point of view, we crossed 100 lakh crores for the first time in FY19. We believe credit growth will increase to 14%. And we believe that it will be largely driven by a return to growth for corporate credit. Corporate credit, if you look till FY17 and even FY18, was below 5%. That has picked up. We believe it will continue to do so. And one of the things that is helping bankers is a return of credit discipline in some way. Like earlier, we used to say that companies may get sick, but the proprietors or the promoters never got sick. But I think after the implementation of the insolvency and bankruptcy code, we are seeing an uptick in credit discipline. Promoters are apprehensive of losing control over their companies, and that has enabled an improvement in credit discipline. We are seeing special mention account, SMA2, that 60 to 90 day delay, having more than halved vis-a-vis the levels a year back. SME and corporate, SME will also witness a pickup. And as they are coming out of the impact of demonetization and GST, slowly things are falling into place. We believe SME growth will pick up. Retail will continue to grow. Sorry. Okay, after credit growth, I look at between private banks and public banks. Private sector banks in terms of growth are more than double that of the public sector banks at around 20 to 23%. Public sector banks had come up to 7% previous year. They will, in our expectation, move up to 9%. But more importantly, on the incremental credit growth, around 2/3 of that last fiscal has come from private sector banks. Their asset quality levels are better, and more importantly, the capital levels which support credit growth, they have a substantial cushion over the regulatory requirements. So the chart on the right shows how the red section, that is private sector banks, is slowly increasing in share. This is what I was talking about on the asset quality side. After touching 11.5%, it's come down to 9.3% as of March 19. We expect that to come down further in the current fiscal. The other thing which also I wanted to showcase is on the right-hand chart. If you look at the slippages, additional slippages to NPAs, that is also on the way down. After reaching a peak of 7.4% in FY18, it's come down to 3.7% in March 19, FY19. We'll believe it will come down further, because one of the important things to note is NPAs as a percentage of stressed assets has gone up. As against maybe 6 years back, where NPAs were less than half of the stressed assets. Today, they are around 75% of the stressed assets. So, amount of stressed assets required to be further recognized as NPAs is not much. So, while there will be account slipping to NPAs, the levels will be lower than what we have seen before. And as I said, recoveries due to IBC will further help bring the NPA levels down. So just a quick flavor on the NPA levels. March 18, corporate loan NPAs were around 18-19%. We estimate it to have come down to around 16%, largely on account of lesser slippages and recoveries. And on the right side, if you see, NCLT 1 and 2, when they initially were referred to IBC, constituted around 40% of the overall NPAs in the corporate loan NPAs in the banking system, just to buttress the fact that it is the large loans which are sinking or impacting the banking system rather than the small loans. Small loans are there are NPAs there, but in terms of recovery and extent, they are lower than the large loans. Here again, I wanted to kind of put together an analogy. There was our yesteryear actor Ajit. He used to play the villain role in Hindi movies. So he used to say when he was torturing someone, he used to put that guy in liquid oxygen. And he would say that liquid तुम्हें जीने नहीं देगा और oxygen तुम्हें मरने नहीं देगा. So I think the asset quality situation in public sector banks in the past has been similar to that. You can say that NPA उन्हें जीने नहीं दे रहा है, government उन्हें मरने नहीं दे रहा है. So in terms of capital infusion and support, while there are issues on government ownership, but in terms of existential support and financial support, that has been coming in. And today they won't be in this position unless if that 2.1 lakh crore of capital infusion had not happened. So that is another angle wherein there is some delta as far as the public sector banks are concerned. On profitability, as I said, public sector banks have been weak in the last few years because of NPA levels and provisioning requirements. Private sector banks have been doing well. So the top bars represent the profitability of private sector banks, and the red line shows the overall banking system profitability, and the negative ones are the public sector banks. So negative of public sector banks should come down going forward, and we believe they will actually turn the tide this fiscal. Private sector banks will continue to register profitability. Capital ratios, 14.3 is that tier 1 for private banks, 10% for public sector banks. So the government capital infusion has enabled public sector banks to increase their provision levels. So today it's excess of around 60%, which is a reasonable level of provisions on an aggregate basis. So this is my last slide. So if I look at what are the key takeaways on the banking system, there are positives, there are concerns. On the positives, I would say that asset quality challenges seem to have peaked. Make no mistake, they are not out of the woods as yet. NPAs are still high, but as against where we were a year or so back, things are better. Recoveries going forward is expected to support NPA levels, and this is what we have seen globally. It takes 3 to 4 years for a bankruptcy legislation to actually take impact and become streamlined and the recoveries to creep in. I think we are slowly getting there. Yes, there will be some teething issues, but over maybe the next couple of years, things should fall in place. Credit growth is gaining ground. Provisioning cover is reasonable. And on the monitorable side, we believe that profitability concerns will still be there. So this year, it will be for public sector banks, a bit of here and there, may just turn the tide. Capital is again a challenge today also. Difficult for them, many of them, to kind of raise capital externally. They still depend on government for support. And on the NPA side, while corporate loans, we don't expect it to go up further, but SME, retail, agri, there is a possibility that NPAs, because of the underlying stress in some of these constituencies, we may see some NPA levels going up, but on the whole, we still believe banking sector NPAs will still be on a downward trajectory. That's broadly what I had. Thank you very much for your patient hearing. Thank you.
Thank you, sir. The questions would be taken, addressed by him personally. May I request Mr. M. Narendra, former Chairman and MD, Indian Overseas Bank and member of IMC BFSI Committee, to present a memento to Mr. Krishnan Sitaraman as a token of our appreciation and gratitude for sparing his valuable time to grace this conference. Thank you, sir. Thank you, Mr. Krishnan.